Hello and welcome class 11 commerce students. Today in this class I will start a new chapter from your class 11 business studies syllabus, and that is business finance. I have written the name in the board. You can see business finance is our new chapter from business studies today. First I will try to discuss the concept of business finance. Now every business concerned requires finance for production and distribution of goods. Financing is an important function of business which deals with needs of money in the business, procurement of money in the business. It is a wide term used in the business. Not only it gives the estimation of the amount of fund, but also the sources of finance, investment of fund raised, management of cash, disposal of earnings, and also the control of funds. So the amount of business finance required differs from every business to every business, one business to other. Depending on the availability of finance determines the scales of operations of a business. Now, significance of the business finance. That means the importance I will discuss one by one. Significance of business finance. Now, financing fixed business enterprise require capital for three main purposes. Financing fixed capital requirements, that is purchase of land, building. Financing working capital requirement, that is purchase of raw material, payment of wages and salaries. Financing for growth and expansion program. So any business enterprise require finance for these three main functions. First is to meet up the fixed capital requirement, which deals with purchase of fixed assets, all type of fixed asset, to meet up the working capital requirements, and also to make any extension and growth. So for this reason mainly finance is required. Providing sufficient capital to the business, several sources of finance has been tapped. This includes shareholders, debenture holders, fixed depositors, bank, financial institution. It is the firm who raises the adequate finance from the different sources, from the shareholders who are the owners of the business, from the debenture holders who are the creditors of the business, also take it as a loan from outside or from bank or from other financial institution. So these are the sources from where a business house raises its capital, raises its finance. Now, business, it is a firm which raises the adequate capital, and the following benefits will accrue to it. Business cycle: if some business concern raises the capital, it will help the business cycle from production to distribution of goods, and that will run smoothly. The firm can install latest plant and machinery. There will be no shortage of raw materials and other things, as I have told you over here. The firm can have advantage of business opportunities. It can buy raw materials at a bulk at economical prices. It can hold finished goods in stores to sell them at higher prices in future. It can pay to its creditor in time and enhance its market reputation. So for this reason adequate finance is required. Now I will tell you about the financial requirement. The financial requirement. Financial requirement is needed because There are two types of requirement that can be broadly classified in a business organization. What are the two types of requirement? Number one is fixed capital requirement and number two is working capital requirement. Now, what is fixed capital? Fixed capital denotes that portion of the capital which is invested in purchasing fixed asset of the business like plant and machinery, land and building, loose tools, equipments, furniture and fixture. All these are fixed asset. These are purchased and investment is made to purchase them because these are permanent kind of investment. This is investment for more than 10 years. 5 to 10 years or from even more than 10 years. So this kind of investment doesn't take place regularly. It takes place for a longer period of time. So these investment are called permanent investment. So fixed capital is required to make this permanent investment. So fixed capital requirement is there for to make this long-term investment. Next our investment is next our requirement is working capital requirement. To make the day-to-day expenses to meet up the daily operations of a business, any business house needs working capital funding. Working capital funding is required to meet up all the daily expenses of a business, that is purchase of raw materials or purchase or payment of wages to the workers, payment of salaries, payment of electricity bill, payment of telephone bill, payment of carriage and freight. All these short expenses which are there in a business house in a daily basis, these type of requirement are made by working capital of a business. So working capital requirement are why? Because they are required to meet up this day-to-day operations, these petty operations which are not for longer period but for very short, which takes place within a year, within an accounting year. Now I will tell you about the sources of funds. Now I will discuss about the sources of fund. On the basis of period. First let me classify funds on the basis of period. Period means time. So on the basis of period, as you can see, broadly funds be classified. Sources of fund can be broadly classified on the basis of period into three distinct categories. Number one is long term fund. Next is medium term fund. And third one is short term fund. Now I will tell you about these three funds one by one. First I will talk about the long term sources of fund. The different sources of funds on the basis of period can be classified into three categories, as you can see. One is the long term fund. What is long term sources? It is required for investment in fixed asset like land and building, I have told you, plant and machinery, or financing the expansion programs. And what are the sources of these? The sources are equity shares, preference shares, I have told you. Next comes the medium term fund. Medium term funds, it is required for upgrading technology, introduction of new products. And these sources are loan from bank. The sources are loan from bank, debentures, etc. These are taken from say for 5 to 10 years. These are taken from up to 5 years. These sources are taken from these sources, funds are taken as a loan up to 5 years. 5 years is the time period, since it is based on time period. And third one is the short term source of finance. And short term source of finance, the fund are, it is required for meeting up the short term needs of the financial concern, and the period is up to 12 months. Fund is required within 12 months. So very short period. And sources are trade credit, factoring, etc. Factoring, etc. In my next class, I will talk about these in details. These three sources, I will talk about these three sources in detail in my next class. Wait till the next class.